What if everything you thought you knew about the stock market was wrong? Yes, we're bursting the bubble today, peeling back the layers of misconceptions and myths that have clouded our understanding of the stock market. You've probably heard it all before. The stock market. That's where you go to get rich quick, right? Or maybe it's just a fancier form of gambling. And surely you need a mountain of money to even think about starting. Well, let's clear the air a bit. The idea of the stock market as a quick route to wealth is as misleading as they come. Yes, some people do make a lot of money quickly, but that's not the norm. It's the result of high-risk strategies, a bit of luck, or inside knowledge. In fact, the majority of day traders lose money. It's not a get-rich-quick scheme, but a tool for building wealth over time. And the gambling comparison? It couldn't be further from the truth. When you gamble, you're leaving everything to chance, but in the stock market, your decisions are based on research, analysis, and informed predictions. There's a method to the madness. Now let's talk about the big money myth. Do you need a lot of money to start investing? Absolutely not. Thanks to fractional shares, you can start investing with as little as the price of a cup of coffee. It's not about how much you start with, but how consistently you add to your investment. So, there you have it. The stock market isn't a fast track to riches, it's not akin to gambling, and you don't need to be a millionaire to get started. These are not just opinions, but facts backed by countless studies and statistics. Now that we've debunked some common myths, let's dive into the surprising realities of the stock market. Because as it turns out, the truth is far more interesting than the fiction. Do you know that the stock market is not just for the wealthy? This might seem counterintuitive given how we often hear about millionaires and billionaires making their fortunes in the stock market, but the reality is, it's not just a playground for the rich and famous. Let's debunk some myths. First, the stock market is not a casino where you're gambling your hard-earned money away. It's a marketplace of companies, and when you buy a share, you're buying a piece of that company, a stake in its future success. You might think you need a lot of money to start investing, but that's not the case. The truth is, you can start small. Many successful investors have started with just a few dollars. Yes, it's not about the amount you invest, but the consistency. Investing is like planting a tree. You don't plant a seed today and expect a fully grown tree tomorrow. It takes time, patience, and regular nurturing. The same goes for your investments. Even the smallest investments, when made consistently, can grow into a substantial amount over time. So, how does the stock market become a tool for wealth creation? It's through the magic of compounding. When you invest your money, it earns a return. When you leave that money in the market, the return also starts earning a return. This is the power of compounding, and it's how small investments can grow significantly over time. And the best part? Anyone can invest in the stock market. You don't need a degree in finance or a six-figure salary. All you need is a little bit of money to start, a willingness to learn, and the patience to let your investments grow. So, let's toss aside the image of the stock market as a high-stakes poker game, reserved only for the Wall Street elites. In reality, it's a field open to everyone, a tool that can help you build wealth over time, no matter your starting point. The stock market is an accessible and viable investment option for everyone. Have you ever heard of the term compound interest? It's a term that gets thrown around a lot in financial circles, but many people don't know what it really means. Today, we're going to demystify this term and show you just how powerful it can be when it comes to growing your investments. In simple terms, compound interest is the interest on your initial investment or principal, plus the interest that has already been added. It's interest on interest. It's your money making more money. And the longer you leave your money invested, the more time it has to compound, and the larger your investment grows. Now let's take a hypothetical example. Imagine you start off with a small investment of $1,000. You decide to invest it in a stock that offers a yearly interest rate of 5%. After the first year, your investment would grow to $1,050. That's your initial investment plus $50 in interest. Now, here's where the magic happens. In the second year, you don't just earn interest on your initial $1,000, you earn interest on the full $1,050. That's compound interest. And if you were to continue this for 20 years, your initial investment of $1,000 would grow to more than $2,650. That's more than double your initial investment, and all you did was leave your money alone to grow. That's the power of compound interest. It's why small, regular investments can grow into a large sum over time. It's why the richest investors in the world swear by the practice of long-term investing. So the next time you're hesitant about investing because you feel like you don't have enough money, remember the power of compound interest. Even small investments can grow exponentially over time if you just give them the chance. The magic of compound interest is one of the stock market's best-kept secrets. Do you think putting all your eggs in one basket is a good strategy in the stock market? Well, let's explore that thought. Diversification, in the context of investing, is the act of spreading your investments across various assets or asset classes. It's like a buffet spread where you don't load up your plate with just one dish, but a little bit of everything. Now, why is diversification so important? It's all about managing risk. When you invest all your capital in a single stock, you are essentially tying your financial future to the performance of that one company. If it does well, great. But if that company goes under, so does your investment. Diversification, on the other hand, spreads the risk. By investing in a variety of assets, you are not overly dependent on any single one. Even if one investment doesn't perform well, others might. And this can help balance out any potential losses. In fact, a study by the University of California showed that portfolios with 10 or more stocks were significantly less risky than those with fewer. So diversification isn't just a buzzword, it's backed by research. But it's not just about quantity, it's also about quality. Diversification is not just about owning different stocks, but also about having a mix of different types of investments: stocks, bonds, real estate, commodities, and more. Each of these asset classes behaves differently under different market conditions. Having a mix of them can help ensure that you're not overly exposed to any single market fluctuation. Diversification also doesn't mean you should randomly pick investments. Each investment should be carefully chosen with consideration of your financial goals, risk tolerance, and investment timeline. Remember, diversification is not a guarantee against loss. It's a strategy to manage risk and increase the chances of getting a return on your investment. It's about playing smart, not just playing big. So the next time you're contemplating your investment strategy, consider spreading your eggs across multiple baskets. Diversification is a crucial strategy in stock market investing. Do you believe that investing in the stock market is a sprint or a marathon? Well, here's the shocking truth, friends. It's not a 100-meter dash, it's a marathon. It's the long game. And playing the long game in the stock market is all about patience. It's about understanding that Rome wasn't built in a day, and neither is a robust stock portfolio. You see, the stock market isn't a casino. It's not about quick wins or instant gratification. It's a platform where businesses grow, innovate, and create wealth over time. It's a place where patient investors, those who understand the ebb and flow of markets, often come out on top. Let's consider this. According to a study by Dalbar, an average investor who stayed invested in the S&P 500 for the past 20 years would have seen an annual return of around 6%. However, if that same investor missed the best 20 days in that 20-year period, their return would have been less than 1%. Just think about that. The point is, it's not about timing the market, but time in the market that truly counts. It's about sticking with your investments through the highs and the lows, through bull markets and bear markets. It's about understanding that the stock market, like life, has its ups and downs, but over time, the trajectory has always been up. And it's not just about patience, it's also about discipline. It's about consistently investing a portion of your income month after month, year after year. It's about resisting the temptation to sell when the market is down or to buy when the market is up. It's about staying the course, no matter what. So remember, when it comes to investing in the stock market, it's not a sprint, it's a marathon. It's a game of patience, discipline, and resilience. It's a long game. In the stock market, slow and steady often wins the race.